Well, hello, my name is Mike Solomon with the law firm of Solomon, Steiner, and Peck. And if you're online here, I see a number of you online. We're doing a seminar called Planning for the Biden Tax Law Changes. Now, let me do a few administrative chores first. If you have any questions, and we've been doing a number of these seminars, I think if you can email them or chat them in the box. You have a question and answer box somewhere on your Zoom meeting, and I'll try to answer those. And I may take questions as we go along. I think you can raise your hand. I think I will see those if you do. If not, every now and then, after I hit a section break point, I will stop a moment and see if I can see if anyone has any questions that I can answer, oral questions, but certainly feel free to write them in. We do these seminars. We're trying to reinstitute them, doing them every number of weeks. Just for your information, we have a seminar coming up on February 16th. Lori Steiner, my law partner, will talk about the income tax consequences for Social Security benefits, Medicare benefits, and long-term care insurance. And then on February 23rd, Jennifer Peck will give a presentation on income tax consequences for retirement accounts and IRA conversions. And then I'll be presenting a seminar again on March 2nd, doing on income tax planning for 2021. So if you're on our mailing list, which you are, most of you, please feel free to attend any of those seminars. You'll be getting notices of those later. Also, if you've found out about this seminar at another place off of social media, if you want to be on our email list, email us at the email address you have responded to for the seminar, or at my email address on the screen here, and we'll put you on the mailing list. And additionally, when we're done with this seminar, we will email everybody who attended a copy of this PowerPoint outline that I'm going to go through right now. And then finally, I'll mention this also later in the seminar. If you have, I was looking at a question. I have to get used to doing that at the same time talking. So if you ever want to sit down with one of the attorneys, Lori Steiner, myself, or Jennifer Peck, regarding some estate planning or tax planning or other, we also do business and real estate, feel free to give us a call at our office at the number that's on the screen there, 216-765-0123, and ask for an appointment, and then we'd be glad to help you. So with that in mind, I'm going to start on the seminar. And if you'll skip all the way to pages, hold on one second. Let me see if I can, oh, there we go. So skip to the third page, which we're going to talk about some estate tax changes that are being proposed. So if you go to page 4, let me cover the existing law. The existing law is right now, there's a federal estate tax exemption of $11,700,000. So a husband and wife is over $23 million from the federal estate tax. There's an exemption. So for most Americans, the federal estate tax under existing law is really irrelevant. There's very few people that are subject to that number, that federal estate tax. And once you're above that, the tax rate is 40%. The other existing law provision that's been in the law basically since the beginning of the tax law is called the income tax step-up and basis rules. This is real important. So on death, all your capital gains are wiped out on most of your investments. For example, let's say you bought game stock for $1. That's now worth $800. If you sold it today, you'd pay capital gains, maybe around 20%, and I'll get into that later. If you gave it away to your children and they sold it, depending on their tax bracket, they pay capital gains. But if you die holding the game stock shares, all those capital gains are wiped out. And so when your family inherits the shares or your estate sells those shares, there's no income tax. And that's been the law basically forever. Now, there are exceptions. Tax-deferred accounts like IRAs, traditional and Roth IRAs, 401k plans, annuities, things like that, those do not receive a step-up in basis. Some annuities, I think, that were prior to 1980 receive a step-up, but most annuities, all annuities issued after that date, there's no step-up in basis when you pass away. So all those assets, when you take out of your traditional IRA, is going to be subject to income tax. I didn't even need to mention Roths because there's no income tax when you take that out anyway. So when you take money out of an IRA, there's no step up in basis. You'll pay income tax when you receive the money. And then at that point, you have a higher basis. So your regular investments, not in a retirement account, all the capital gains are wiped out. So that's the existing law. Now, on the next the next slide, obviously we have an election. We had an election and Biden is the president. And right now the Democrats control the Senate and the House. And prior to the election, when people thought it was going to be a wider margin in the Senate, many people thought a lot of this legislation would happen almost instantaneously. It's a 50-50 tie at in the Senate with the vice president having the deciding vote. So there's still many people think this will go through or some modification of it. So the federal exemption potential that Biden might lower the federal exemption to is from 11.7 million down to 3.5 million and raise the tax rate from 40 to 45%. Now, again, for most Americans, so for a married couple, we're talking about $7 million. For most Americans, that's not going to be an issue. But for more and more Americans, that will be an issue. So you need to think about that. In addition, if Congress does nothing, the federal exemption, the law, the tax law, the way they pass these tax laws now, they last for 10 years and then they disappear, go back to the old law. So in 2026, most of the changes that were passed in the Trump first year of the Trump administration will expire. Not all of them, but most of them. One of the ones that will expire is the federal exemption will drop back to the pre-2017 level, which back in 2016 was probably like $5.1 million. That's adjusted for inflation. So from 2017 through the beginning of 2026, I've made an estimate of inflation. Obviously, it's just an estimate. And I've estimated that the exemption in 2026, if Congress does nothing and the law expires, will go back to around a level of $6 to $6.5 million. So that gives you a sense of where we are. So there's another, go to the next slide. There's another potential change. Biden is thinking about getting rid of the income tax step-up and basis rules. So now I've mentioned this has been around since the beginning of the income tax, basically. There was one period of time where the income tax step-up and basis rules disappeared, and that was in 2010, when Bush #2 had passed that new law, and the estate tax was disappeared in 2010, and they put back the income tax step-up, and they got rid of the income tax step-up and basis if you're a state, if you passed more than $1.3 million, or for a spouse, $3 million. So you had a limited step-up in basis. Now, again, no one knows if this will get through anyway, if they'll get rid of the income tax step-up in basis, and if they do, whether they're going to put some sort of de minimis amount. The first $1.3 million gets a step up. So it all depends on what the law looks like. But and there's no real planning for this right now. So if they get rid of it, it means when your children, whoever inherits your assets, they'll still have that capital gains following it. So eventually there'll be some income tax owed on that. Additionally, there's a concern that they're going to limit the amount of gifts you can make. Again, this is because they don't want people to somehow get away with some of the estate taxes they may owe. So they're going to limit the total amount that you can give away during your lifetime to $1 million. Right now, the exemption for gifts is the same as the exemption for death. You can give away $11.7 million free of income tax, free of gift tax to whomever you want to give them to. So they may limit that. So the state exemption, exemption from the federal estate tax may be $3.5 million, but the income tax step up and the amount you can give away might be capped at $1 million. A lot to digest. So the next question is, before I get to that, so there are some other things. Again, if you're in a high estate tax bracket, you have a large estate, they may get rid of all these sophisticated tools or limit them. They're called grantor retained annuity trust, effective grantor trust, charitable trust. All these sort of things may be limited. We don't know exactly yet how they will be, but they may be. And then more important, we don't know yet what the effective date of all these changes are going to be. Last year, I was advising my wealthier clients, the ones that had estates of 10, 15, 20 million or more, they might consider doing things in 2020 because no one thinks they're going to go retroactive to that. So if you made a large gift in 2020, they're not going to go back and say, okay, now you owe more tax on that. But there is a concern that they could pass the law and make it effective January 1, 2021. That's a possibility. They have the constitutional right to do that. Or sometimes what happens, they'll pass a law and they'll say it's effective for anything that happens on or after the date the law is passed or on or after the date the law is introduced. So we just don't know what's going to happen yet. So the next question is, what do you do? So there are several things. If you have an estate greater than $3.5 million, you need to consider doing something now before any legislation is passed, because it's possible they'll make it retroactive to January 1, but maybe not. Maybe they'll introduce the bill. And again, this has happened before. They'll introduce the bill in March, let's say, the tax legislation, and then it'll take a number of months before it passes. And they'll say anything that happened on or after this date is governed by the new law. So if you have more than $3.5 million, you need to at least sit down and think about whether you want to do anything to try to avoid this problem if the new law kicks in. Next question, what if you have less than $3.5 million? Do you have to do anything? Well, if you have older documents that were done in, let's say, the 1990s, when the exemption was a little over 600,000, or if you even had them during the 2000s, when the exemption was still a lot lower, you may have had an estate plan that focused on saving federal estate taxes. There's a yin and a yang with federal estate tax planning. To save federal estate taxes, you have to give up the income tax step up and basis rules for the assets that you're saving estate taxes on. So you may have heard of a term AB trust or credit shelter trust, things like that. So most older estate plans, certainly ones in the 1990s and in the 2000s, would have what's called a B trust, a bypass trust, or sometimes called a credit shelter trust. And in that trust, when you passed away, was the amount of the exemption. So let's say, to make easy numbers, the exemption when you set up your plan was $3 million. And on your death, on the death of a spouse, $3 million went into that credit shelter trust. Okay. Now you've saved all the estate tax on that or whatever it grows to. That's great estate tax planning. But any future growth of those assets inside that credit shelter trust do not receive the income tax step up and basis. So for example, if on the death of the first person, $3 million goes to the credit shelter trust because it was set up in the 1990s, your estate, let's say, is $3 million. But you did your estate planning back in the 1990s or early 2000s. And your estate plan says on your death, all of your assets go to the credit shelter trust up to the exemption amount. Well, let's say you have $3 million. $3 million goes into the credit shelter trust. No estate tax, but you weren't going to have it anyway. And then in the meantime, that $3 million, let's say, grows to $10 million. You bought all that GameStop stock, grows to $10 million. And then you die. There's no income tax step up in basis. So when your children sell that stock or when the trust sells that stock, you're going to pay all that capital gains. Where if you had that $3 million in your name and on your death, it went to your surviving spouse, let's say, rather than into that credit shelter trust. When he or she died after it grew to $10 million, all the capital gains are wiped out. Well, if the exemption still stays at the very high number we're talking about, but if it still stays at $11 million, you weren't going to have an estate tax anyway. But you now avoided, in my example, you avoided like 7 million times 12, like $1 million of capital gains tax. So the point is, there's no one answer fits all. You need to look at your situation, look at the size of your estate, the potential federal exemption, depending on the law, and look at your documents. So if you have old documents, you'll look at them anyways, but they were probably designed to save federal estate taxes and not worry about the loss of the step up of income tax basis. You need to focus on that. Excuse me 1 second. So I think I've answered one of these questions was, is there any reason to update my current plan, which divides as equal as possible between my husband and wife with an AB trust? Any harm in keeping even? Yes. So I answered that question. There could be harm if you leave your estate plan alone because husband dies, the money goes into this B trust, and we avoid estate tax that's never going to impact you. But we also lose the step up of income tax basis when your wife dies in this example. You ought to examine these because many of our clients nowadays, if we're not worried about the federal estate tax exemption, we do what's called a joint trust. The reason I say that is back then, back in the 90s, each spouse had their own exemption. So I'll use the husbands in my example. If the husband had a $3.5 million exemption and the wife had a $3.5 million, and the husband died and he didn't use his exemption, it was all lost. Under the law that passed, I'm losing track of time, but a decade ago, you get to inherit your spouse's unused exemption. So if the husband dies and doesn't use any of the exemption, the wife will have a $7 million exemption. So with that in mind, we don't need two trusts, one for the husband and one for the wife, if we're really not worried about the estate tax, or we think the combined exemptions of the husband and wife will be more than enough to cover all the assets. So let's say you have $5 million. Well, if $5 million, and if you don't think it's going to grow to more than $7 million, even if Biden goes back to the $3.5 million exemption amount, a husband and wife together will have a $7 million exemption. So in that situation, I might do a joint trust for the husband and wife. Husband dies first, no estate tax. Wife dies, $7 million exemption. That $3.5 million grew to $7 million exactly. No federal estate tax, but by having that joint trust, if it's properly drafted, we get another step up of income tax basis on the wife's death. We eliminate all the growth that occurred from the date of the husband to the death of the husband to the death of the wife. So that's a really important planning tool. So anyone who has documents that were older should have them looked at anyway. Your wishes may have changed, but the tax law has changed tremendously. And your plan that may have been a perfect plan in the 1990s or the early 2000s just may not be appropriate at this point in time. And also, by the way, there's the Ohio Trust Code that's passed in 2007 that may change how we want to draft the documents. And I'll mention one other thing as an aside. Ohio also modified in 2012 the law regarding financial powers of attorney. So it might be worthwhile looking at those documents unrelated to any tax planning to see if those documents are up to date and satisfy your needs. And also one other thing that's happened in the last X number of years, probably 5 or 6 years, a lot of the banks are worried about liability for honoring these financial powers of attorney. These are documents where you give someone the right to sign paperwork on your behalf. So for example, the surviving spouse might name their children on a financial power of attorney. So little Johnny can go to the bank and sign paperwork on your behalf. Banks now want to see language in that document that says if little Johnny comes in and abuses the power of attorney, the bank's off the hook. They don't want you to come back later and sue the bank because they shouldn't have honored the power of attorney. So some banks are not honoring the power of attorney unless it has that language in it that says they're off the hook if they follow the terms of the power of attorney. So if you have an older power of attorney, you might want to look at that anyway and modify that to add language to get the banks off the hook so they'll honor the document. So does anybody have any other questions so far? That I think I've answered all those, and I don't see any hands written as far as I can tell, any hands raised. So if anyone has a question, they want to text it to us on the or want me to talk to them directly, just tell me and I'll open your mic. So in the meantime, let's go to the next slide. Whoops. Yeah, there we go. Hold on one second. Okay, so let's talk about IRAs and 401ks. Okay, so let me just pull up my outline here. So I have to look at these notes a little bit. So under the current law, you can contribute up to $6,000 to a traditional IRA plus another $1,000 if you're 50 or older. If you have wages or self-employment earnings. So it's not just you have interest and dividends, that won't qualify. There are similar rules with a Roth, except you qualify for that full contribution only if your income is below a certain amount, $125,000 for a single person, $198,000 for a married filing jointly, excuse me. And then there's the backdoor Roth where you contribute to a traditional IRA. Your income is such that you don't qualify for a deduction, maybe because you were participating in another pension plan and you have a high income. You can make a non-deductible contribution to an IRA and then convert that to a Roth. It gets real complicated, and Jennifer will probably address that in her seminar coming up in a number of weeks. 401k plan, you can contribute up to $19,500. Plus, if you're 50 or over, another $6,500 on top of that. Now, a recent change is they got rid of the 7.5-year rule on limiting when you could contribute to a traditional IRA or Roth. Now, even after your 7.5, if you have salary or self-employment earnings, you can contribute. You can continue to contribute to these plans. Excuse me. So that's an important change for people who are still working and want to put more money aside. Now, go to the next slide, please. Now, they changed the required minimum distribution date to age 72. If you were born on or after July 1 of 1949, you don't have to start taking minimum distributions out till age 72. We're used to be age 7.5. If you're born prior to that date, you're still under the old rule and you've been taking them. So that the contribution, well, let me skip one of the bullets. Let's go to the third bullet. In 2022, they were going to do this in 2021, but they delayed it a year. In 2022, they have a new life expectancy table. People have a longer life expectancy. COVID to the side, they're not going to change it because of that. They've added a new table that gives people longer life expectancy. What that means to you is that beginning in 2022, whatever calculation you use to calculate your required minimum distribution, it's going to stretch out a little bit because many people try to take out just the minimum required distribution and let that money continue to grow tax-free or tax-deferred in their traditional, tax-deferred in their traditional IRA. Of course, you don't have to take out any money from your Roth IRA until you want to. There's no required minimum distribution. So that'll kick in 2022. So just be aware of that. And then the second bullet, the contribution to a traditional IRA is as I mentioned this earlier, actually, is an above-line deduction unless you're participating in another qualified plan, and then it's reduced and possibly eliminated, depending on your income level. But you can always make a non-deductible contribution to the IRA. So, for example, if your income's too high and you're participating in a retirement plan, you cannot make a deductible IRA contribution. If your income is too high, you can't make a Roth contribution. But what you can do, no matter what your income is, you can contribute to a non-deductible IRA and then convert that to a Roth IRA. Now, unfortunately, if you have a lot of IRAs, you can't pick and choose which one to convert. So sometimes it's not practical, but look into that for yourself, and you have until April 15th, if that's not on a weekend, to make a contribution. Any other questions so far? Okay, so let me continue on. Now, there are a bunch of new potential changes to the tax law that Biden may propose. One is that right now when you contribute to an IRA or a 401k, it benefits the higher income tax bracket people compared to a lower income tax person because they have a higher income, their deduction is worth more. They're thinking of changing that 401k contribution and the IRA contribution to a tax credit equal to 26% of what you contribute. So if you're on a personal income tax bracket above 26% right now, you lose on the deal. If you're 26% or if you're below 26% tax bracket, this is a better deal for you. And I give you some details of who's in that bracket in the outline here. So let's go to the next slide. So what do you do with all these potential changes? Nothing. You can't do anything about it. You don't know what's going to happen. You're just going to have to wait it out and see what Congress does. Now, let me talk about capital gains rate, because this is really important. Right now, under the existing law, basically the maximum capital gains rate you can have is 20% if your income is over $510,000, if you're married filing jointly, plus another 3.8% investment income tax if your income is above $250,000. So the maximum capital gains bracket for very high income people is 23.8% plus whatever they do in the state of Ohio or wherever you may live. If the taxpayer is in the 10 or 12% bracket, there's a zero capital gains rate. And if you're above that and below that maximum, you're in the 15%. So that's generally how the rules work. I see a question regarding another topic, so let me just cover that. Question is, the new IRA distribution tables, will they affect an inherited Roth IRA? And will they affect people that are already taking the required minimum distributions? The answer is yes. So if you've been taking required minimum distributions in 2022, you can use the stretch out. The same thing with an inherited Roth. Once 2022 happens, your required minimum is going to change. It'll drop, which is good obviously for people if they want to take advantage of that. So let me go back to my outline here. So the capital gains rate I just mentioned. Now, the Biden proposals. So right now, he's saying he's going to raise the individual income tax rate on regular income from 37% back to 39.6%. That was the tax rate during the Clinton era, if you earn more than $400,000. So if you have that 3.8% net investment tax, also your bracket could get up to 43.4%. The state of Ohio, you're close to 50%. Now, the proposed capital gains rate right now is for individuals earning more than $1 million, which is obviously a very small group of people. So, you either have to have a lot of income just day to day, or you sold a mother load of investments and you're getting above the $1 million. And then they're just going to go to the ordinary income rate of 39.6%. That's a major change. Actually, the capital gains rate has always been a preferred rate compared to the regular ordinary income rates, except for a few years during the Reagan administration, when I don't know if you remember, they had only 2 or 3 tax brackets, and there was no capital gains rate because the maximum rate, I think, was 28% back then. So they're talking about tinkering with this. We'll see what happens. For most of you, this is irrelevant, but maybe not for everybody. So the question is, what do you do? Well, if Congress raises the capital gains rate, one of two things are going to happen. Everyone who's caught by any of these increases, and again, if it's $1 million, it's going to be fewer people. But if it impacts more people, what's going to happen is people are going to say, well, if the law kicks in 2022, I'm going to sell in 2021. There is a history where Congress, from time to time, with the capital gains rate, has made it effective the date the law was introduced in Congress or when it was passed to avoid this. Now, I personally don't think it'll happen this time because I think they'll want people to sell. So if they raise the rate beginning in 2022, then everyone will start selling in 2021 and Congress will get more tax money and it'll look brilliant because now the tax deficit won't be as high. But again, no one knows for sure. I took some time to try to see when the last retroactive application of the capital gains tax happened. To be honest with you, I know it's happened, but I couldn't find it. But it's something you need to think about. If you have a large capital gain and you think the law may impact you, or they may go lower in the amount that they're going to, in other words, they may make the capital gains rate higher for people in a little bit lower bracket, then you might want to consider selling. Again, it's a little bit of a crapshoot. You just have to see what happens. Someone asked me how much is a mother load. That's good. I like that. I don't know, but it's a lot. Now, there's some miscellaneous proposals that Biden is thinking about. One, it deals with itemized deductions. They raised the personal exemption a considerable amount, so many people don't even need to itemize. But he's thinking of, for the people who itemize, making the following changes. Number one, getting rid of the $10,000 cap on state and local taxes. There's a limit on how much you can deduct if you itemize. But also limiting the amount that wealthy people, whatever that means, can deduct by 2 ways. Number one, limiting the value of the deduction to 28% of the deduction, and not whatever bracket they're in. In other words, if they're in the 39.6% bracket, they'll only get a value of the deduction as if they were in the 28% bracket. And also putting back in place a law that existed prior to 2017, where if you had a high income, the amount of itemized deductions you got was reduced by a certain percentage. Thank God for computers, because it'd be impossible to figure all this stuff out. But they're thinking of looking at those changes. The other change, I'll assume no one in the audience is directly worried about this, but you may have children or grandchildren who have student loans. And they're thinking of forgiving some portion of it. So the talk has been somewhere between $10,000 and $50,000 of forgiveness of student loans. Now, historically, when a loan is forgiven, like from a bank or from any other person, it's an income tax event. So if you borrowed money from the bank and they let you off because you couldn't pay it, or or if they forgive a student loan, it was income to the borrower. So people are looking at that as a double whammy. You just got out from under the loan, and now you owe the IRS 20% or whatever your bracket is of the amount of loan forgiveness. So they're thinking about providing that student loans that are forgiven will not be subject to income tax. Some other Biden proposals. A lot of people, as they get older, have children or other, or relatives or somebody else provide caregiving for them, and it's an expense. Sometimes, if they have long-term care insurance, it might be covered by that. And there's not a lot of details of this, but Biden may propose a $5,000 tax credit that you receive if you have to pay what they call an informal caregiver, which include family members. So it's just something to watch out for. It's a benefit for people who need that. Also, long-term care insurance. And again, they didn't give a lot of details of this, but they may pass something to increase the tax benefits for people who buy long-term care with retirement assets. I forgot to mention, by the way, this mess behind you is really a fake mess. It's not my real office at all, but I have this diagram to make myself look busier, so I have this fake mess behind me. So that's it's actually my real office. It's embarrassing. It's that messy. What can I tell you? Then finally, the proposal is he may increase the FICA tax on anyone who earns more than $400,000. So the FICA tax, as you know, is a Social Security tax, and the employers and the employee each pay the same amount. I believe this might just be on individuals and not the employer. I'm not positive on that, but on individuals, it'll be an additional 6.2% if you're in more than 400,000. So it'll be like a whole. So the first, I can't remember right now, the taxable wage base, I think is the first 120,000, you pay the Social Security tax. And when you get above that, there's no Social Security tax anymore on you as an employee. There still is the Medicare tax, which is 1.45%. That goes on forever. So what's going to happen if this passes is you'll have 7.65% of the first 120, 6.2% of your Social Security tax, 1.45% of Medicare. Then after that, from let's say 120 to 400, you'll have 1.45%. That's the Medicare tax. And then when you get above 400,000, you go back to 7.65%. That's again on salary that you receive from an employer. If it's self-employment taxes, you have the honor of paying both halves of that, the employer portion and the employee portion, which is pretty significant. Any questions? Any additional questions? Okay, let me continue on. Oops, I went too far. There it is. Okay, so another proposal is he may eliminate like-kind exchanges for high-income taxpayers. So this is another one of those things. If they do, a lot of people sell their commercial properties or rental properties. Rather than sell them and pay the capital gains and buy something else, they will sell them and use a technique where they get what's called a like-kind exchange, where they can take that money, and there's several ways to do it. One, you have it held in escrow by a title company, and in a certain period of time, you take that money and you reinvest it in additional like-kind real estate. You don't have to pay any capital gains or any income tax on that until you sell that new property. They're thinking of getting rid of that. So again, that if you have that sort of thing and you're thinking you want to swap your property for something else, you might want to seriously consider doing that now, because who knows when that law will take effect if they do pass it. Finally, they're talking about expanding the ABLE accounts. That's for people with disabilities to cover adults and certain veterans. And they didn't give any more detail on it than that. Now, there was another tax law that passed at the end of 2020 called the Tax Certainty, I don't know what's certain about it, and Disaster Tax Relief Act of 2020. Now, what this law did was make permanent, for example, if you have a lot of medical expenses and they're above 7.5% of your adjusted gross income, you can deduct those excess amounts. They had raised it to 10%, then temporarily reduced it back to 7.5% for certain older Americans. Now they've made it permanent 7.5% for anybody. They've eliminated the qualified tuition deduction, but they've increased they've made the lifetime learning credit more accessible because they lowered the income limits for that. They have continued a provision that happened during the Great Recession, where if you have loan forgiveness on your house, that it won't be included in income. That continues to 2025. It was set to expire in 2020. Next, they have extended the charitable deduction. There's now an above-the-line deduction. Used to be you could only take charitable deductions if you itemized, and now they've increased that to they've extended that through 2021. So you get an above-the-line of $300 as an individual and $600 a married couple. So it's just a little something for people who give something to charity, but don't itemize. They get a little bit of a tax benefit, not earth-shattering, but it's there. Another one that is probably not practical for a lot of people, but there is a maximum limit on how much you can give to charity and deduct each year. It used to be 60% of adjusted gross income. They temporarily raised it to 100%, and they've continued that through 2021. Another one that may be more practical is if you have flexible spending accounts. If you're working and you have a flexible spending account, they have this strange provision. You have to use that money up before the end of the year, except you could carry over $500 to the next year. That's why a lot of times at the end of the year, you see these advertisements from vision companies and eyeglass people. They come on in and use your flexible spending account so you don't waste it. It was a use it or lose it. So you took your own salary, put it in a flexible spending account, and you had more than $500 in there, and you got past the year, you lost it. So now they've allowed you to carry it over if your employer provides that in their plan, and that continues through any plan year that ends through 2022. So keep that in mind. Your employers may be making changes like that. Any questions on all that? I just have a little bit more. Okay, I don't think whoops. So let me talk about some other tax matters. Number one, you may remember in 2020, they extended the time to file tax returns and even pay your taxes. IRS has said they don't contemplate doing that this year. So assume that you've got to pay your taxes by April 15th and file your return unless you file for an extension. The IRS is going to increase the use of its high wealth audit program. They call it the Wealth Squad. And they try to focus on individuals who have a large high net worth and look at the entities they control, kind of make sure they're not doing anything wrong. And that's going to continue. And then if you've been buying a lot of Bitcoin, buying and selling, they're going to focus on virtual currency compliance issues to make sure that those follow all the rules. I don't know much about that, but that's what they're doing. So now that's our seminar for today. Again, let me cover some housekeeping issues. We'll send you all copies of this outline. I mentioned that we have some upcoming seminars. Already lost the page when we have them. But we have some upcoming seminars in, here it is. So we have one coming up on February 16th with Lori Steiner, talk about income tax consequences for Social Security benefits, Medicare benefits, and long-term care insurance. We have one coming up on February 23rd by my law partner, Jennifer Peck, income tax consequences for retirement accounts and Roth IRA conversions. And then we have me, I'm going to talk on March 2nd about some last-minute income tax planning not last-minute, income tax planning for 2021. Make sure you think about that in advance, not wait till the end of the year. And we're going to be doing these through the rest of the year every few weeks. So, if you want to be on that email list, if you respond to this email, you're already on it, unless you found us off of social media, and then communicate with us and tell us you want to be on the list. If you have any questions of me, just email me at the email address that you see at the front page of this outline, which you'll receive. And if you want to set up a personal planning appointment, these are meetings that usually last a couple hours. If you're talking about estate planning, we'll go over your estate planning documents. If you're talking about, as I tend to also do other things like real estate and business, but we generally charge for a flat fee for the initial consultation, which usually lasts an hour and a half or 2 hours, of $275 for the entire meeting. And I think you'll find it worthwhile if you do call in and set up a meeting. So I'll hang around here a little bit longer in case you want to ask any questions. Otherwise, thank you very much for coming, and we'll see you next time.